Hello. In our other videos, we have talked about captives in general and why they make sense. In this video, I would like to focus on the banking industry. Banks have made dramatic changes to the risk management in the past decade, and the pace of change shows no signs of slowing. Giving strategic direction to a bank means understanding what drives the creation of value and what destroys it. The corporation needs to understand the risks which it can take and the risks which it should avoid. Not all bank risks can be addressed by commercial insurance coverages. Often banks must self-insure key risk, whether deliberately as a process of professional risk management or by default through lack of risk management and planning. Serious emerging risks such as cybersecurity, data privacy, and brand rehabilitation can create big exposures for financial institutions of all sizes. At the same time, commercial insurance carriers impose ever higher deductibles, and there always remain significant gaps in coverage and exclusions in commercial insurance policies. This creates unfunded risks, which must be evaluated as a part of any bank's enterprise risk management process. One way bankers can begin to take back control is by focusing on the administration and control of the many hidden risks faced by a typical institution. A growing number of banks are forming private insurance companies, commonly known as captives, to cover these types of self-insured risks. Let's talk about captives. Many trusted financial advisors are familiar with the concept of captives, but remarkably, they remain little used by smaller banking institutions. Captives can deliver a package of benefits that help to protect the net worth of a bank. Many larger bank and non-bank companies have long managed their insurance coverage and hidden risk as part of a coordinated risk management program. One of the key tools of risk planning is the captive insurance company. In essence, by owning your own private insurance company, a captive opens the door to insurance cost savings, risk transfer, and increased profit potential. In fact, more than 95% of Fortune 1000 companies and many other successful small to mid-sized companies throughout the U.S. operate captives. Captive Alternatives is focused on making captives understandable and convenient for banking industry risk managers and CFOs. The types of risks covered by a banking captive can include credit card risk, brand rehabilitation, loan buyback, loss of contract, or other highly focused coverages. With prudent management and an effective risk management program, the captive can invest surplus funds and build up a tax-efficient war chest for the owner, which may be used in future years to fund business expansion or for retirement planning. Generally, a bank with pre-tax profits of $1 million or more would form a captive. The captive's risk management and asset protection benefits, combined with the tax incentives, often combine to make it a very attractive strategic option for growing banks. Captives are generally organized as small insurance companies taking advantage of a 30-year-old section of the tax code. Captives can be located in a variety of jurisdictions, including offshore locales, as well as many states in the U.S. Recently written international insurer legislation in Puerto Rico makes the establishment of a Puerto Rico-based captive very beneficial for a U.S.-based owner. A captive insurance company must always be established with a bona fide insurance purpose, that is, as a facility for transferring risk and protecting assets. Selection of an experienced captive manager, along with a team of industry experts, is a major consideration in constructing and managing your captive. Done right, the captive can be one of the most powerful financial and business planning tools available to successful financial institutions.